So it does do very good for your purchasing power, but this debasement is a real issue because most things just don't keep up with the debasement. So you're right, we're not going to have a massive debt blow up. What we're going to have is this.
When you invest in cryptocurrencies, it's crucial to brace for volatility. According to Raoul Pal, this is a normal part of the crypto investment experience. Historically, investors have seen multiple significant drawdowns each year, with fluctuations often ranging from 30% to 40%. Recently, Bitcoin experienced a 27% drop, which is within the typical range of volatility for this asset class. Pal highlights that such price movements should be seen as part of the normal ebb and flow of the market. What's essential is understanding the underlying factors driving these fluctuations. For instance, the business cycle plays a significant role in influencing crypto markets. Currently, we're witnessing a gradual economic recovery, with inflation rates decreasing, interest rates expected to fall, and liquidity returning. Historically, these conditions tend to create a favorable environment for cryptocurrencies.
When you invest in the crypto asset class, you expect volatility. If I go back over all the years I've invested, most years you get 2, 3, or even 4 30% drawdowns. This one in Bitcoin has been 27%. It's kind of within the range of normality. And what you need to ask yourself is the main drivers of crypto are the business cycle, i.e. where are we with the economy? Well, we're starting to pick up slowly, inflation's coming down, rates are going to come down, liquidity is going to come in, and so therefore that's usually a very good time for crypto. So the tailwind is behind you. And the other thing, are people adopting the technology? Are things being built on it? And that's ongoing too. So when you see a news event like the last few days, driven by macro factors, you tend to think they're likely to be short term. Now, if the business cycle was getting old and the economy was starting to feel a bit more fragile, then yes, you might be worried about it. But this is early in the cycle, and generally you have to expect the volatility. And how I've always dealt with it is a Jedi mind trick, which is you look forward to it. When it happens, you can buy more, and you get to compound your returns much better than anybody else who just does nothing or tries to trade around it. So you should be thinking of these sell-offs as a gift, is, oh wow, if I can find a bit more cash, I can put it into the market, and you tend to do really well over the cycle by doing that strategy. It's generally not the change of interest rates. Nobody really cares if your rate goes from 10 basis points to 25 basis points or whatever, right? What it actually was the move in the yen, because you have to pay back, you're borrowing yen. When the yen starts moving a lot, then that starts concerning you. The yen went up a lot, so suddenly the amount of yen you've borrowed has gone up in dollar terms. So what happens is everybody reduces risk. And that was the real thing, is the Bank of Japan started intervening in the currency market because their currency was too weak. And they started selling dollars and buying their own currency. That's what everybody borrowing yen went, oh my God, now suddenly, yes, I'm getting a cheap pickup in borrow, but bloody dollar yen is moving 2% a day every single day, and I'm losing a lot of money. And what happens is a risk manager comes along at a bank or a hedge fund and goes, you need to close your positions or reduce your risk. And that's really what the last 4 days were all about, was the risk manager tapping somebody on the shoulder saying, listen, you're losing money on this side, you need to start reducing risk. And that's why everything gets hit, from crypto to NASDAQ to mining stocks to oil to anything, any risk at all. But these tend to be very short-lived because, once the market resettles, they get used to the change, people have been washed out of positions, it then kind of settles back to normalcy. And these, I call them macro spasms, they don't usually last very long. Could it last a week? Could it last 2 or 3? That's possible. 2016 saw very similar. The dollar had been very high. The world economy was super slow. World trade had slowed down because the dollar was so strong. And the Japanese came in and intervened in their currency. All the markets blew up. Exactly the same mechanism. But what happened after that was the central bank started stimulating, particularly the Chinese, because they've been waiting for this moment to do so. The Europeans last time around and the UK last time around. This time, I think it's going to be the Chinese who are going to stimulate. And why they get to stimulate is they couldn't do much cutting of interest rates or stimulating of monetary policy because their currency was too weak and they didn't want to lose control of it. But now the dollar has weakened, they're able to do more. So I think really it's probably a net positive. Just give it a few weeks and it's probably very positive. Now, inflation itself is driven by a lot of lagging factors, and housing is the big lagging factor, and wages, both of which are coming down. So we should see inflation much lower. Now, if I look at something called inflation break-evens, that's Wall Street's guess of where inflation will be in 1 year's time. If I look at it now on my Bloomberg screen, it's at 0.63%. So they're pricing in a massive undershoot of inflation. So it's telling us that rates should come down significantly. Right now, they're probably 100, 150 basis points too tight. And I think they should come down to probably around 2%, which is also very convenient because this year, the US Treasury has to roll $10 trillion of debts. And it's very expensive to roll it at 5.5%. It's a lot easier to do at 2%. So, I think it's a blessing, and the Fed will want to get rates as far down as possible for the next kind of 12 months when they have to roll all this debt. It's like nobody wants to refi their mortgage at 5.5%. They want to refi it at 2%. It's exactly the same mechanism for the government because it costs you a lot.
Pal notes that the current interest rates are likely too high and need adjustment to facilitate economic growth and manage debt. As governments roll over large amounts of debt, lower interest rates would reduce the cost of borrowing. This adjustment is crucial as it mirrors how individuals seek to refinance their mortgages at lower rates when possible. In terms of asset performance, Pal compares different investments over time. He notes that while traditional assets like the S&P 500 and NASDAQ have seen moderate gains, Bitcoin has significantly outperformed, with a yearly return of around 150%. This outperformance is partly due to Bitcoin's ability to maintain purchasing power amidst broader economic debasement.
If you think of most asset prices versus this debasement, the S&P is doing about 8% a year since 2012, which basically just keeps your head above water. The NASDAQ's done about 17%, but Bitcoin's been doing 150%. And when you look at NASDAQ versus Bitcoin, the NASDAQ is down 99.97%. So it does do very good for your purchasing power, but this debasement is a real issue because most things just don't keep up with the debasement. So you're right, we're not going to have a massive debt blow up. What we're going to have is this ongoing bleeding of all of our purchasing power. So the volumes in ETFs are driven by two: net inflows, or people known as arbitrageurs who are arbitraging the futures market. So we don't know what that flow was. So they would sell the futures which trade at a premium and then buy the ETF. We don't know what that flow was, but let's assume it's net inflows because Binance saw record inflows yesterday as well. So what we're seeing is people, I think, because of the education that you've been doing, I've been doing, Michael Saylor's been doing, everybody's been doing, people are starting to understand the game. And even Larry Fink has been explaining the game. The game is the erosion of your purchasing power, not via traditional CPI inflation, but via this more pernicious debasement idea. And I think people are understanding and have been educated that this is a volatile asset class. And, as I started at the beginning of the show, is if we do get sell-offs, people are starting to realize that's when I buy. That same strategy worked incredibly well in the NASDAQ over the years as well. You've got a big secular trend, any wobbles, generally a buying opportunity. So I actually think it's a bit of a red herring because the US dollar is the world's reserve currency. The US doesn't need to hold other assets in reserve. Yes, it's got gold, but that was a legacy from leaving the gold standard. Other countries have to have reserves to support their own currencies, so they don't need it. Now, would they do it? I think it sounds flashy. For what reason, I don't really know. But let's assume that they do. Let's say I'm wrong and they do build something. It's kind of a weird world because, yes, obviously it's good for the crypto market because there's yet another buyer. But it's also weird because Bitcoin was set up to try and replace the government's control over money, and now you're inserting the government as one of the largest buyers of private money. I don't really like that, actually, but it's probably net positive for the crypto price. Now, maybe it pushes private use of money away from Bitcoin if that were the case. Because if the government can manipulate it, they could dump it onto the market, they can buy more, and before you know it, they're using it like they are interest rates and controlling regular money, and we don't want that. NFTs are probably the most powerful technology in the whole crypto space. In a world where everything digital goes to zero in value, because you can make more of it, nothing can maintain value. What an NFT does is create digital scarcity and thus digital value. It also is a mechanism of storing and transferring ownership of something, a digital right, a contract. So the NFT craze of, monkey JPEGs and stuff, that was just the first iteration of using the technology. Some of those things, digital art, I think is going to be extremely valuable over time. But this technology is going to be used for all sorts of things, whether it's global ticketing or digital ID, or we've seen California start to adopt it for your car deeds. I think we'll use them for property deeds. I think we'll use them for derivative contracts. So NFTs as a technology haven't even started. They will be so pervasive that you won't even know that every ticket you go to an event is an NFT. Every contract that you have will be an NFT. Most securities that you might trade may be NFTs. But some of the art, and I've been collecting people like Xcopy and Beeple, these people are cultural artists that are very relevant to this time, and I think they'll be very valuable over time. So it's going to be a bifurcation as ever, but the best assets win.
In summary, Raoul Pal provides a comprehensive analysis of the current crypto market dynamics and broader economic trends. He emphasizes that volatility is a natural part of investing in cryptocurrencies and suggests viewing market pullbacks as opportunities to buy. With macroeconomic conditions improving and potential stimulative measures on the horizon, the outlook for crypto and NFTs remains positive. As always, it's crucial for investors to stay informed and be prepared for market fluctuations. By understanding the underlying factors driving these changes and maintaining a long-term perspective, you can better navigate the complexities of the crypto world.